This is such a predicament of Cirrus research. The latest signals report is just out. The title, Extreme Tech Weighting Hamstrings Risk Management. And what we're getting at here is a simple comparison. The technology sector now represents almost 50% of the US large cap market. That makes it very hard to be running a diversified active portfolio. If we compare this reading right now to the peak in 1999 or 2000, that number was around 37%. So there's a 10% gap here where the technology sector's climbed even higher. At the low point in the last 30 years or so, the exposure for technology was about 13% at the lows in the 2003-2004 period. So what does this mean, though, for a portfolio manager running a diversified portfolio, let's say running it through an optimizer? What's it going to say? In other words, in order for you to look as if you're not taking an active risk, you need to own almost half your portfolio in the tech sector. And that really sets up for the challenge that we've got here running money going into 2026. Importantly, a number of shifts occurred in the last few weeks. The market had run up. We're seeing a lot more volatility now. Our asset allocation model has begun to fade equities in the last couple of months. The latest reading fell further, now down to about a 24% asset allocation. Remember, the long-term number is really a 49% reading. So the equity allocation today is well below average. And the question is, what's driving that? I think it's obvious that the sort of very narrow market, a very speculative market, is truly capturing the fears right now of investors, and that's what's also reflecting this most volatile move. In terms of the critical pillars that we monitor, bottom line, we are going to be a lot more defensive as we go into closing the year. We've got an underweight in equities or a fixed income overweight. We've got a lean value reading, which is not a market for chasing very speculative stocks. Risk appetite's extremely speculative. I'll go through that. And the market has been crowded now for 3-4 months by our measure. This is the CRX, which is a measure for speculation in the US. This number is now a 40% reading. This is well above what we have seen in the last major peak, such as in 99. So what this suggests is that investors begin to become more valuation sensitive, not less. And I suspect this is what's been driving, even this full year, how investors, if you look at global markets, the US is actually lagging a number of markets overseas. If you look at the US intra markets, really since April, small and micro caps are now outperforming the broad market. So to some degree, I think what's forcing investors to diversify is this idea that you've had a major run, speculation is rampant, so what do? You play a little bit of defense. The crowding model also really for the third month remains in this most elevated level. So what that means is that a handful of companies between the AI-driven market and maybe some of the financing, those are effectively what's driving up this crowding in the market. So with any questions, please feel free to reach out to us. Thank you.